Another blowout United States jobs report has just collided with an AI-driven equity boom and a record-breaking IPO pipeline, and volatility is finally waking up. You are watching vTalkInsight, Equity Pulse Daily for June 8, 2026. Today we unpack how the growth and inflation reset, the tech-led sell-off, and the coming SpaceX listing are reshaping equity risk and opportunity. The starting point for this week is the sheer strength of the latest United States labor data. Non-farm payrolls rose by 172,000 in May, almost double the consensus, with earlier months revised higher and the three-month average climbing to its best level since early 2024. On the surface, that points to a resilient economy and supports the idea of a soft landing rather than imminent recession. Yet wage growth is only around 3.4% year-over-year, below inflation and running at 0.3% month-on-month, so pay packets are not driving a new inflation spiral but real incomes are being squeezed. The tension comes from the inflation side. Headline consumer prices are expected to re-accelerate above 4%, with services and supply chain pressures keeping global inflation near or above 3%. And that combination has pushed Treasury yields higher across the curve and shifted markets from pricing cuts to penciling in a possible Fed hike by year-end. Commentary now points to rates potentially staying unchanged through 2026, with some arguing that massive AI infrastructure spending is lifting the so-called neutral interest rate and making it harder to justify easier policy. Equities have digested higher yields reasonably well so far, but several voices flag that a move in long-term yields toward 5% would become a direct challenge to current valuations in the United States and other developed markets. Against that backdrop, stocks and bonds are moving more in tandem, reducing diversification benefits and pushing attention back onto earnings resilience. The key macro signals from here are simple but critical: the next inflation prints, energy prices in a still fragile Middle East, and any hint that wage growth is re-accelerating, because all three feed directly into how far the higher for longer narrative extends. That macro reset has collided with very concentrated leadership in equities, and the result has been a sharp pickup in volatility. After roughly 9 weeks of steady gains, the S&P 500 dropped more than 2.5% on Friday, and the volatility index jumped from the mid-teens into the low 20s, while the Nasdaq 100 fell more than 4% in its worst single session since 2025. Technology and AI-related names have been at the center of both the advance and the drawdown. Major chip stocks like AMD, Intel, Micron, and Broadcom pulled back sharply after a powerful run since March, and European tech dropped around 2% as weakness in the global AI trade rippled across regions. Several observers describe a momentum-driven tape where even minor earnings or guidance disappointments trigger outsized negative reactions, regardless of the underlying sector strength. Market breadth remains thin, with a low share of stocks outperforming the S&P 500 and the top 10 companies accounting for roughly 45% of index market cap, so any wobble in those leaders has an exaggerated impact on benchmark performance. Under the surface, leadership is rotating. Flows are moving out of high-flying tech into more defensive names such as Eli Lilly, JP Morgan, and Berkshire Hathaway, while in Europe, utilities, retail, and healthcare are driving modest gains even as technology lags, and there are signs that industrials and infrastructure companies tied to AI-related demand are starting to attract more attention. South Korea's Kospi, which had been one of the world's strongest markets this year and a key barometer for the AI theme, offers a clear illustration of how quickly sentiment can turn. After a 100% year-to-date rally driven by extraordinary earnings growth, the index is now seeing more than $10 billion of foreign outflows, elevated retail leverage in exchange-traded products, and a correction that some frame as healthy consolidation but others see as a warning on how stretched AI positioning has become. Behind the volatility, the structural AI story remains powerful. Global AI-related capital expenditure is expected to exceed $800 billion and could approach $1 trillion, with hyperscalers such as Google raising around $80 billion of funding and signaling sustained and possibly increasing investment in data centers and AI infrastructure. Within that, NVIDIA still occupies a dominant position, maintaining strong pricing power and stable margins because large cloud providers have limited alternatives for high-end AI accelerators. NVIDIA has approved several manufacturers, including Micron, to supply high-bandwidth memory, and Micron has at times outperformed the broader tech sell-off after being highlighted by NVIDIA's chief executive, showing that there is still selective strength inside the semiconductor ecosystem. However, the latest leg down in AI stocks after Broadcom delivered earnings that met, but did not exceed, expectations underlines how stretched sentiment has become. There is a growing debate over whether current semiconductor margins are being driven more by temporary pricing power than by enduring productivity gains, which would leave the sector vulnerable to future earnings disappointment as supply catches up and unit prices normalize. At the macro level, the sheer scale of capital needed for AI infrastructure is now seen as one factor pushing up the neutral interest rate, undermining earlier narratives that AI would be primarily disinflationary. On top of that, the prospect of greater regulatory involvement, including proposals for the United States government to take equity stakes in firms like OpenAI or impose one-off taxes, adds a layer of policy uncertainty that could matter for how AI valuations are framed over the coming years. Turning to liquidity, the headline numbers suggest plenty of dry powder. Roughly $7.78 trillion sits in money market funds. Bank deposits remain solid, and there are persistent inflows into both cash and bond vehicles, all of which on paper should help absorb new issuance in fixed income and equities. The nuance is that many institutional investors are already fully invested, and the equity market itself is shifting from a regime of net buybacks to one of net issuance. Increased secondary offerings and a wave of upcoming IPOs mean the scarcity premium that supported high valuations is fading, and abundant new paper could weigh on prices unless demand grows meaningfully. The SpaceX listing is the focal point of that wave. The company is targeting $75 billion of proceeds at a fixed price of $135 per share, with only about 4% of the company initially floated and roughly 30% of that float earmarked for retail investors, an unusually large allocation that could amplify early trading volatility. Structurally, the IPO is designed for rapid inclusion in the Nasdaq 100 after 15 trading days, while S&P Global plans to delay S&P 500 inclusion for about a year. Given that around $26 trillion is benchmarked to the S&P, those index committee decisions can drive large, non-fundamental flows, and a scenario where SpaceX becomes a major Nasdaq component, but remains outside the S&P could create pronounced divergence between the two benchmarks. Fundamentally, SpaceX is pitching a vast opportunity set across launches, Starlink Internet, enterprise AI, and hyperscale compute, with a stated total addressable market of more than $28 trillion and revenue projections of $300 to $400 billion by 2030. While some argue that recent AI deals and potential acquisitions could quickly lift revenues and compress the IPO price to sales multiple from near 100 times toward 40, others question whether that pace of growth is realistic and point to mixed precedent for mega-IPOs, including a difficult early trading period for Meta after its debut. In credit, the message is mixed. On the positive side, private credit stocks have recently outperformed after Blackstone reported stabilizing withdrawal requests in a flagship vehicle, and commentators note that risk premia for illiquid assets look more normal and potentially more attractive than in the ultra-low rate period of the past decade. Yet under the surface, stresses are building. Some private credit funds are imposing withdrawal limits as redemptions rise. A significant share of portfolio companies are paying interest in kind, and around 40% are generating negative free cash flow, while exposures are concentrated in life insurers and the overall sector has reached a size comparable to pre-crisis subprime. At the same time, a coming surge in Treasury issuance raises questions about how easily long-term yields can be contained, especially with the Japanese yen under pressure and the risk of Japan selling treasuries to defend its currency. Flows into bond funds favor corporate over government debt. Stocks and bonds are highly correlated, and that is encouraging more focus on real assets and on how rate volatility can spill back into equity valuations. Company news rounds out the picture with notable dispersion. Lululemon has cut its revenue guidance, citing weak North American traffic and intensifying competition, and its shares have fallen more than 10%, underscoring pressure on discretionary spending even in a strong jobs market, while at the same time analysts have upgraded names like Chipotle and Inditex on the back of strong positioning and accelerated investment plans. In industrials, Boeing is planning to raise monthly production of the 737 MAX from roughly 42 to 47 aircraft, and to 52 by early next year with a new assembly line in Everett. Management is emphasizing stability and quality over speed, and persistent bottlenecks in seating and engine deliveries on the 787 program show how supply chain frictions remain a constraint even as demand stays robust. Among mega-caps, Apple's share price is up around 16% this year on optimism about its AI roadmap, but with the stock trading above 30 times forward earnings, there is talk that even a strong developer conference reveal could invite a sell the news reaction. Outside the United States, European healthcare and defense stocks are quietly outperforming. UK equities are seen as a potential diversifier thanks to their energy exposure and relative insulation from Middle East tensions, and emerging market equities are highlighted for attractive valuations and earnings momentum in a more multipolar world. Pulling it together, the equity backdrop is now defined by a stronger than expected growth pulse, inflation that is refusing to fall back to pre-pandemic norms, and policy expectations that have swung from imminent cuts toward a higher for longer stance. At the same time, an AI-driven earnings boom, a record SpaceX IPO, and heavy issuance across credit and equity markets are redistributing liquidity and leadership, leaving indices increasingly sensitive to single stock moves, sector rotations, and flow-driven technicals. Over the next few weeks, the key signals to watch are inflation and wage data, the behavior of long-term yields, the durability of semiconductor margins, and how the SpaceX roadshow and pricing are absorbed, because together they will shape whether this latest bout of volatility remains a consolidation or turns into something more structural. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.